So in this video, I'm going to share with you 3 option strategies is all you need to trade all the different market conditions that there are. So you might be wondering, first of all, what are the different market conditions? Well, there are just a few, right? So basically, these are the types of positions that you want to take. So the first type of condition would be when the market is going to be bullish. So this is the time where you are bullish and you want the market to go up. So you can trade a certain type of strategy to help you capture these types of market condition. Now, the next one is when it's bearish. So I'm going to put it as bear. So again, there are option strategies that you can trade to capture the moves to the downside. And the last market condition is when the market is neither bull or bear, and it's just going sideways. And as you can see, just these 3 alone already cover all the different types of market conditions. So you might be wondering, okay, so what kind of strategies do we trade for all these different types of conditions? Well, very simple again. So if it's going to be bullish, then you can trade the bull put spread. So what is the bull put spread? Also known as the put credit spread. And what about the bear condition, right? When the market is in a bearish condition, then you can trade the bear call spread. Again, this is what you call the call credit spread. And lastly, what if the market is going sideways? What strategies can you trade? Well, you can choose to trade the iron condor. So the iron condor is basically a combination of the bull put spread and the bear call spread, and when you put them together, you're going to get a structure that looks like the iron condor, where the whole goal is for the market to stay in between those 2 spreads, and you're going to capture a profit there. So there you go. All you need is just these 3 strategies to trade all the different market conditions. Now, the next question you probably have in mind is, okay, Davis, this is all good, but how do we actually know what condition the market is in? And that is a good question. So for this, the simplest way, or rather one of the simple way that you can use to identify this condition, is by using an indicator. So basically an indicator, something like the stochastic oscillator. So as you can see over here at the bottom, this is the stochastic oscillator. And as you can see over here, there are 2 red lines here. So anything above the red line at the top, this is what you call overbought condition. So overbought is usually the time where the market has bought up quite a bit, and this is usually the time where we want to be a little bit more bearish, right? Because as you can see over here, once the market is kind of like overbought, there tends to be kind of a pullback to the downside. Same thing over here, when it's overbought, then you can see the market goes down. So if you want to be strategic in how you place your trades, then usually you want to use this stochastic indicator as a way to kind of have an indication of what kind of direction you want to trade. So if the market, or rather the indicator, is showing that it's overbought, then this is where you want to use the bear call spread. So you want to trade it to the downside. Now, what about when it's a bullish time? When do you put on the bull put spread? Well, it's the opposite. When the indicator is showing an oversold condition. As you can see over here, oversold down here. Usually this coincides when the price have sold off quite a bit. And usually when the price is sold off quite a bit, there can be a movement back to the upside. Same thing over here as well. When it's oversold, as you can see over here, during oversold, then the market goes back up. So as you can see over here, just from this indicator, this stochastic indicator, you can identify when the market is overbought or oversold, and this helps you identify which of these 2 strategies for you to put. Now, what about the one where the market is going sideways? How do you identify when the market is going sideways? Well, again, a very simple way is to just use this stochastic oscillator. So basically, whenever the market is not overbought or oversold, then you can consider putting on the iron condor. Now, this is optional because with this indicator down here, this stochastic indicator, you already can identify 2 types of directions you can trade. When the market is going to be probably going up, so you trade the bull put spread, or when the market is likely to go down, then you trade the bear call spread. But there are some times, as you can see over here, there could be periods of time where the market is neither overbought or oversold. So during those times, if you want to put on a trade, what do? Well, you can consider putting on the iron condor. So of course, there's going to be some nuances. on how we're going to trade each of this, and I'm going to share it with you. So first off, before I get into that, some people have asked a little bit more about this indicator. They asked, Davis, can I use the RSI, or can I use other indicators that also show you whether it's overbought, oversold? Then you can, right? So if you want to use the RSI or any other indicator, you can as well. I'm just using this as an example. So if you're just curious, how I use this stochastic oscillator, what is the settings, then go over to my channel and type stochastic oscillator, because I already have a video where I share all the settings, how you actually use the stochastic oscillator. So as you can see over here, this is the slow stochastic, and I use it only on the daily time frame. If you want to use it on the other time frame, like the weekly or monthly, you can as well, but I don't suggest anything lower than that, because then there's going to be too much noise. So for our purposes, at least for the way that we're going to trade the options, the trades, daily is going to be more than enough. Okay, so we've already identified that we're going to use the stochastic oscillator, at least in my examples here, to identify these three conditions. How are we going to actually put on the trade? So let me just walk you through it. So first off, let's just take a look at this chart over here. So as you can see over here, right now, the stochastic oscillator is showing that it's somewhere in between down here. That means to say it's neither overbought nor oversold. So this is where you can choose to actually trade the iron condor. So when you want to put the iron condor, this is what we want to look out for. We want to look out for previous support and resistance. So this is important, because when we are trading the iron condor, we want the price to actually stay in a given range. And the given range will be basically where our short strikes are. So how do you identify the previous support and resistance? Well, all you got to do is just draw a line at where the previous high and lows are. So in this case, let's just say this is where the current price now. Now, you can definitely use this as a previous high, but you can see that there's another previous high down here. So I actually like to use the one that is previous higher than this. So as you can see, I want to use this high. And as for the previous low, you can see previous low is here and another one is down here. So these are the intermediate ones that we are going to use. So when you're trading the iron condor, we want the price to actually stay within a given range. So since the price is right now down here, ideally, I want my short strikes for my iron condor to be above and below this support and resistance levels. So in this case, I really want to use those two that are just further out. So these are my ranges for my iron condor. So that means to say, when I choose my short put strike, I want to ensure that my short put strike for the call spread side is going to be above this resistance levels. So this is where I'm going to sell my bear call spread, right? This is one part of the iron condor. And at the bottom side, I want to ensure that my bull put spread, which is the second part of the iron condor, is going to be below this support down here. So this is very important, because this is going to be pretty much where our range is going to be when we are trading the iron condor. This is our profit zone. That means to say, as much as possible, hopefully the market does not go above these two support and resistance levels. That is why it's important to identify the support and resistance levels. Because if the market goes up here, well, there's a chance that if it finds some resistance at where the previous high was, then the price can go back down. Even though it may momentarily just go above, it could possibly go back down again because of this resistance. Same thing at the bottom side. If the market goes down, then hopefully it finds some bounce down here based off the previous support, and the market can go back in again. So this way, we are placing our iron condors at a more strategic place rather than just randomly putting it on. While you can randomly put it on, and of course there are studies by the Tasty Trade team where they just randomly put it on, but if you want to be more selective, especially if you don't want to continuously put it on and take it off, put it on and take it off, then this is a way for you to identify places for you to put the iron condor. So as you can see over here, when you're putting on the iron condor, you've identified the previous resistance levels as well as the support levels. Now the next step you need to do is to identify this short put strikes, or rather this call spread and the put spread, to ensure that you're actually able to get this strikes outside of this region down here, this zone down here, where we have identified the previous support and resistance level, So once you've gone to the option chain, you identified this, then this is where you can put on the trade. However, another important thing you need to take note of is to ensure that there is no earnings when you're putting on any of the trades, right? Be it the bull put spread, the bear call spread, or the iron condor. That is because when earning comes, then this is where it's going to have a very possible big movement. It can possibly just blow through the support and resistance. So that is why it's very important to make sure that when you're trading the strategy on the underlying that you selected, there is no earnings that's coming up in the next 30 days or so. So how do you identify whether there's going to be an earnings that's coming up? Well, one way is to go to the earnings calendar. So you can go to Google the underlying that you're planning to trade and see whether there's earnings coming up. Now, the other way, a more quicker way, is that you can actually just go to the option chain and see whether there's this earning lines that come up down here. So it shows up for Tasty Trade. It also shows up for Thinkorswim. I'm not too sure about the other trading platforms, but if your trading platform doesn't actually show this, then maybe it's time for you to change to another trading platform, maybe, right? So as you can see over here, this is Netflix, and straight away you can see that there's an earnings date announcement here. It says April 17th, which means to say this is just not going to be our candidate. We cannot trade this. So if we cannot trade this, then you want to move to something else. So again, very important. So now what do? We just simply head on to the next underline. By the way, if you like this video so far, please subscribe and also click the thumbs up button. And also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So I'm just going to remove all this drawing down here. So let's just say I'm going to move on to the next underlying. Let's just say it's Microsoft, right? So as you can see over here, this is Microsoft. So Microsoft, let's take a look at what the stochastic is saying. So over here, you can see stochastic says it's somewhere in the middle down here, which means to say this is considered somewhat of a sideways condition according to the stochastic oscillator. But you can see the market actually calmed down quite a bit, right, for Microsoft. So if you want to trade the iron condor on this, what do? Then you want to identify previous support and resistance as well. So if I was to zoom out a little bit on the chart, I need to identify where is the previous support area. So if I was to go to the chart, you can see that the previous bounce, really the previous kind of low, will be somewhere around here. But I would actually prefer a more defined one like this. So you can see the previous one will be something down here, and then somewhere below here, you notice that there's no real support. So I don't really kind of like this, but we will just plot this out. So I'm going to plot out a line down here so you can have an idea where this previous support is. And then the next one is just going to be too far out. So chances are we're not going to be able to find a short strike down here. So I'm just going to plot this out down here. And then let me just remove this drawing. I'm going to find the previous resistance level. So previous resistance level is going to be either above here or here. But again, it's going to be a little bit too far out. Now I can use this, but I would actually kind of prefer the one above. So I actually want this. But straight away from here, I know it's just going to be too far out. And you can see that the market has kind of broken out of the range down here. So in this case, I wouldn't like to trade the iron condor in this case. So what I'm going to do, I'm just going to give it a miss. So I'm just going to go to the next one on my watch list. So again, very important for you to have a watch list of stocks so you can cycle through them, because not every single one you're going to find that you're going to have an entry. So next one, let's say we're going for Tesla. Let's just take a look at Tesla. So Tesla is a little bit past the overbought range down here, and it's somewhere coming down to somewhere in the middle. So you could consider this an iron condor trade, but ideally, you also want that the line down here maybe is somewhere in the middle as well. So let's just say, for example, you do want to trade the iron condor on Tesla. So how do we do this? Same thing as well. Let me just try and find the previous low. So as you can see over here, there's a few previous low. There's one that the previous bounce is this, and then there's this one down here as well. And then there's another one down here. So I'm going to draw all the lines down here. I'm going to draw this line down here, lock it in place, draw another one at the next low, which is coinciding down here. Lock this in place as well. And what about the previous high? Previous high, this is a little bit too near. I want to use the one above down here. So this should be a pretty decent place for me to put the resistance level. And let's see, is there any other previous support level? Okay, so probably there's another one down here as well. And I'm going to draw another one down here. So once I've already identified these levels down here, ideally, if I can, I want to find the strikes for my iron condor that is above here. So this is where my call spread is going to be. And then down here is where my put spread. So ideally, I want one that is, of course, if I can get the one that is the lowest down here, that would be the most ideal one. So what I'm going to do is I'm going to head on over to the option chain to see if I can find a spread that's above 367 and maybe below 182. Okay, so as you can see, I'm on the option chain down here, and Tesla also is going to be having an earning announcement around April 22nd. So we definitely cannot use this as well. But however, I'm just going to show you how to find the short put strikes and a short call spread, just in case, let's say there's no earnings down here. Okay, so let's just assume there's no earnings and we are trying to find the short strikes for the iron condor to put on Tesla. So the first thing we want to go to is somewhere around the 45 DTE. So I've already explained this in quite a number of my videos. Why we want to go around 45 DTEs is because this is where our edge is, where the realized move is more often the time lesser than the expected move. So this is where we have our edge in option selling. If you want to go anything lesser than that, well, then the risk is going to be on you because we're not going to have the edge. Okay, so I'm going to choose roughly around 46. So remember, we want to have our short strikes somewhere below the support and also above the resistance, which we have identified here. So hopefully above 367 and again below somewhere 182 if possible. But at the same time, we want our option strikes to be within the range of 16 to 20 deltas. So this is where the expected move is. So we don't want to go too far wide, because if you go further out than that, right, more out of the money than those 16 to 20 deltas, then your risk to reward is not really going to be there. And if you're going to be a little bit too aggressive, that means you go for the higher deltas, then your profit zone is not going to be too big as well, right? So this is where a fine balance we need to strike. So ideally 16 to 20 deltas. So as you can see over here, somewhere we can go for around the 200 and 205 on the short put side, and on the call side we can go for somewhere around, let's take a look at the delta, 16 to 20 delta. So probably somewhere around here, which is around 340. So let's take a look at the chart again, and you can see that 340 is actually below here, and $200 is actually somewhere around here, right? So if I was to position my iron condor, then the iron condor would basically be somewhere around here, the short put strike. Okay, let me just remove this. So if I was to draw the short call strike, it should be somewhere around here, 340, and then the short put strike should be somewhere around $200. So it's somewhere below the first support level, but it's the call side is not above the previous resistance level. So in this case, what do? Simply just give it a miss. Do not enter into this trade. Then just move on to find another candidate. So let's take a look at the next stock. So let's take a look at NVIDIA. So NVIDIA, as you can see over here, the stochastic is showing that it's in an oversold condition. So what does this mean? It means now that we want to be taking on a bullish position. So we'll be putting on the bull put spread. So for the bull put spread, what do? We now want to identify previous support areas. So how do you identify the previous support areas? So this is where I'm going to zoom out and then try and find the previous places where the prices have kind of like turned, right? It bounced off. So as you can see over here, I've identified two places. So what I'm going to do is I'm just going to plot the level. I'm just going to draw a line at the previous low down here, and then another one at the bottom down here. So ideally, when I go to the option chain, so first thing again, I want to make sure that there is no earnings that's coming up. If there's no earnings coming up, I'm going to go to the nearest 45 DTE, and then I'm going to pull up the option chain. And I want to try and identify the strike prices that is ideally below these two support levels. And if I can, I'm going to go for the further one, 90.7. So I'm going to open up the option chain and see that if I can get a short put strike that is below 90.7 and is somewhere between 20 to 30 deltas in terms of the strike price selection, then I'm going to put on the trade. So if you can identify that this is around 20 to 30 deltas, you put on the short put at that strike price that is below 90.7. And as for the long put, this is where it really is according to your risk. So if your risk is, let's say, $500, then you can just simply stretch it to about 5 points wide. Okay, so this is what you do when you are trading the bull put spread. For the iron condor, you look for previous support and resistance for both sides. For the bull put spread, you want to identify previous support. Now, what about the bear call spread? Well, the bear call spread, very simple. You just look for the previous resistance. So let's take a look at, let's say, Apple. So just nice, as you can see over here, Apple has just gone to the overbought region, and you can see that the price have gone up a little bit, right? Kind of a retracement. So you can see this could be a good candidate whereby you trade it to the downside. So you do want to have different kind of positions on at any one time. You do not want to only just put on the bull put spread position, because as you know, when there's going to be a very big move, right, usually either up or down, that is not stock specific, but rather market specific, then you're going to see that all the stocks tend to move in tandem. That means if there's going to be a market crash, all the stocks tend to go down at the same time. So you do not want to only put on the bull put spread at any given time. That means only bull put spreads, because if you do that and you just put a bull put spread on all the different stocks, then when the market crash, then guess what? All your positions are going to be hit. Instead, you want to put all the different positions. So that means you want to find stocks with different underlying conditions. So as you can see over here, the Netflix, which I showed you earlier, could be a sideways. Then probably you put on the Iron Condor, given that there's no earnings. Then maybe you identify Nvidia is going to be a bullish position because it's oversold. Then you put on a bull put spread. And then for the Apple, as you can see over here, now it's in an overbought condition. Then this is where you want to put on the bear call spread. So you want to trade it to the downside. So this way, if let's say there's going to be a crash, then at least this position is going to be in a profit, right? At least you do not have all in a sea of red. So this is very important to have different positions to kind of diversify. Okay, so now let's get into the bear call spread. How do we construct this? So first of all, for the bear call spread, is the opposite to the bull put spread. This is where you want to identify previous resistance level. So what I'm going to do is I'm going to draw a line at where the previous high is. So as you can see, this is the previous high, this is the previous high. So you want to draw a line across all of them. So let me just take a line and just draw them here. And this one as well. So ideally, we want to have the short put above this. Now, of course, as you can see over here, this is going to be a little bit too far away. If you're going to go to the option chain and you want to try and identify, you know, the short call strike price to be above at least 250, it's probably going to be a little bit too far away. So if you see that the short call spread is going to be a little bit far away, then what it just means is that you have to wait. You have to wait for Apple to hopefully trade a little bit higher. Then at that point of time, you take a look at the option chain again. Go to the option chain and then see if you're able to find a 20 to 30 delta that is somewhere above this 250. And if you can see that above 250 is going to be 20 to 30 deltas for the short call strike, then you can definitely put on the call spread. So there you have it, folks. This is how you trade all the market conditions using just 3 very simple strategies. So just to sum things up, if you see the market is in an overbought region, then all you got to do is trade the bear call spread. If you see it's in an oversold region, then you trade the bull put spread. And when it's somewhere between the two lines, that means it's neither overbought or oversold, then you can consider trading the Iron Condor. So hopefully this video has been helpful for you. If it has, I would greatly appreciate if you give me a thumbs up on this video and also subscribe to more trading videos like this. And I will see you in the next video.